There is a widely accepted milestone in personal finance that suggests reaching $1 million is enough to create long-term financial security, especially in retirement. And while this number carries psychological weight and appears substantial in isolation, the underlying math reveals that its stability depends less on the number itself and more on how it interacts with time, withdrawals, inflation, and variability in returns. At first glance, $1 million feels like a complete system. It appears large enough to sustain spending, absorb uncertainty, and provide flexibility across decades. But the moment that capital begins transitioning from accumulation to distribution, the structure of the system changes entirely. Instead of compounding working in your favor, withdrawals begin to act as a counterforce, gradually reducing the base that generates future returns. This is the first shift that often goes unnoticed. Because in accumulation, growth is exponential. In retirement, sustainability becomes conditional. The commonly referenced framework for managing this transition is the idea of a safe withdrawal rate, often centered around a percentage that can be withdrawn annually without depleting the portfolio over a defined time horizon. And while this concept provides a useful starting point, it is based on assumptions that do not always hold under real-world conditions. Market returns are not consistent. Inflation is not stable. Spending is not perfectly predictable. And each of these variables interacts with the withdrawal process in ways that can either stabilize or destabilize the system over time. One of the most critical variables is sequence risk. This refers to the order in which returns occur, particularly in the early years of retirement. If negative or below-average returns happen at the beginning, when withdrawals are already in progress, the impact is disproportionately large. Because losses are being locked in at the same time capital is being removed. This reduces the base available for recovery when markets improve. Even if average returns over time are normal, the sequence in which they occur can lead to very different outcomes. This is where the perception of $1 million as a stable endpoint begins to break down. Because stability is not determined by the size of the portfolio alone. It is determined by how resilient that portfolio is to variability over time. Inflation introduces another layer of complexity. While it may appear gradual on a year-to-year basis, over longer periods it significantly reduces purchasing power. This means that maintaining the same standard of living requires increasing withdrawals over time, which further pressures the system. A portfolio that appears sufficient in today's dollars may not maintain the same capacity in real terms over a multi-decade horizon. This creates a subtle but continuous erosion that is often underestimated. There is also the issue of longevity. As life expectancy increases, the time horizon over which a portfolio must sustain withdrawals extends. A retirement that lasts 20 years operates under a different mathematical structure than one that lasts 30 or 40 years. Each additional year increases the probability of encountering unfavorable conditions, whether through market volatility, unexpected expenses, or shifts in economic environment. And as the time horizon extends, the margin for error narrows. Another important factor is variability in spending. Most financial models assume relatively stable withdrawal patterns, but in reality, expenses can fluctuate due to health, lifestyle changes, or external conditions. This variability can introduce additional strain on the system, especially if higher withdrawals coincide with weaker market performance. From a structural perspective, what is happening is that the portfolio is no longer just a pool of capital. It becomes a dynamic system where multiple variables interact simultaneously. Returns, withdrawals, inflation, and time are all influencing the outcome in real time. And because these variables are not independent, small changes in one can amplify the effects of another. This is why the difference between theoretical sustainability and practical sustainability can be significant. Behavior also plays a role. During periods of market decline, the psychological response to losses can lead to changes in strategy, such as reducing equity exposure or increasing withdrawals out of concern. These adjustments, while understandable, can alter the trajectory of the system in ways that reduce long-term sustainability. In this sense, the success of a retirement portfolio is not only determined by its initial size, but also by how consistently the underlying strategy is maintained. There is also a tendency to anchor on round numbers like 1 million because they provide a clear target. But financial systems do not operate based on psychological thresholds. They operate based on flows, rates, and interactions over time. A portfolio slightly above or below that number can behave very differently depending on how those underlying variables are structured. When all of these elements are considered together, it becomes clear that $1 million is not inherently safe or unsafe. It is conditional. It can be sufficient under certain assumptions and insufficient under others. The key is not the number itself, but the system built around it. How withdrawals are managed, how risk is distributed, how flexibility is maintained, and how the portfolio adapts to changing conditions over time. Because in retirement, the objective is not to maximize returns. It is to sustain a system that continues to function despite uncertainty. And that requires a shift in thinking, from focusing on reaching a number to understanding how that number behaves once it becomes the foundation of a long-term financial structure. And when that shift is made, it becomes easier to see why $1 million, while significant, is not a guarantee of stability, but rather a starting point that must be actively managed within a dynamic and evolving system. And when this system is extended further across time, another layer begins to emerge, one that is less visible at the beginning of retirement, but becomes increasingly influential as years pass, which is the interaction between declining capital and rising dependency on that same capital. In the early phase of retirement, the portfolio often still feels large relative to withdrawals. The percentage being removed appears small, and the system retains a sense of stability. But as time progresses, even if withdrawals remain consistent in percentage terms, the psychological and structural relationship to the remaining capital changes. Each withdrawal begins to represent a larger portion of what is left, not necessarily because spending has increased dramatically, but because the base has been gradually reduced through both withdrawals and variability in returns. This creates a slow shift in system sensitivity. In the beginning, fluctuations in the market may feel tolerable because the overall base remains strong. But later, the same percentage decline can feel more significant because it is acting on a smaller foundation that is already supporting ongoing withdrawals. This is where fragility can begin to increase, even if the system appeared stable in earlier years. Another important dimension is how flexibility changes over time. Early in retirement, there is often more room to adjust. Spending can be reduced if necessary. Allocations can be shifted. Time remains available for the system to recover from unfavorable conditions. But as time advances, that flexibility can narrow. Not because options disappear entirely, but because the cost of adjustment becomes higher. Reducing spending later in life may be more difficult due to fixed expenses or health-related needs. Shifting investment strategy may have less time to produce meaningful recovery. And this creates a gradual reduction in the system's ability to adapt, which means that the same portfolio must operate under tighter constraints as time goes on. There is also a compounding effect of uncertainty. While each individual variable, market returns, inflation, longevity, may seem manageable on its own, their interaction over long periods creates a widening range of possible outcomes. This is not linear. It expands over time, which means that the further into retirement the system operates, the more variability it must absorb. And because withdrawals are ongoing, the system does not have the ability to pause and recover in the same way accumulation systems do. It must continue functioning regardless of external conditions. This continuous exposure is what makes sustainability more complex than accumulation. Another layer that often remains understated is the role of partial recovery. In accumulation, downturns can be followed by full recovery because contributions continue and time remains on the side of growth. In retirement, recovery may be incomplete. If withdrawals occur during a downturn, the capital removed cannot participate in the eventual recovery, which means that even if markets return to previous levels, the portfolio itself may not. This creates a structural asymmetry where losses have a more lasting impact than gains of equal magnitude. And over time, this asymmetry can influence the overall trajectory of the system. There is also the concept of threshold effects. A portfolio may operate within a stable range for many years, appearing resilient and well-structured. But once it crosses certain thresholds, whether due to sustained withdrawals, extended market weakness, or rising expenses, the system dynamics can change more rapidly. Recovery becomes more difficult. Options become more limited. And the system can transition from stable to vulnerable in a way that feels sudden, even though the underlying process was gradual. This is why relying solely on initial portfolio size can be misleading, because it does not account for how the system behaves as it approaches different stages over time. From a broader perspective, what becomes clear is that retirement is not a static phase. It is a dynamic process where the balance between growth and depletion is constantly shifting. And within that process, the role of $1 million is not fixed. It changes depending on where the system is in its timeline and how it has interacted with external conditions along the way. There is also an important behavioral shift that tends to occur as dependency on the portfolio increases. When income is no longer being generated through active work, the portfolio becomes the primary source of financial support. This can alter decision-making, not necessarily in obvious ways, but in subtle adjustments to risk tolerance, spending behavior, and long-term planning. These adjustments can, in turn, influence how the system evolves, either by preserving stability through caution or by introducing new risks through attempts to compensate for perceived shortfalls. In this way, the system is not only shaped by external variables, but also by internal responses to those variables. And over long periods, these responses can accumulate in ways that meaningfully affect outcomes. Another dimension is the interaction between time and perception. At the beginning of retirement, the horizon may feel long but manageable. 30 years, for example, can be conceptualized as a structured period. But as time progresses, the remaining horizon becomes less defined. Uncertainty increases, not only in financial terms, but in personal terms as well. And this can influence how decisions are made, sometimes shifting focus from long-term optimization to short-term stability. While this shift can be rational, it can also alter the balance between growth and preservation in ways that affect the sustainability of the system. When all of these layers are considered together, the idea that $1 million is safe becomes less about the number itself and more about how that number interacts with a changing set of conditions over time. It is not that the number is inherently insufficient. It is that it exists within a system that is continuously evolving, where stability depends on adaptability, timing, and the ability to manage multiple variables simultaneously. And this leads to a final perspective that reframes the entire discussion. Financial security in retirement is not defined by reaching a specific number. It is defined by the resilience of the system built around that number. A system that can absorb variability, adjust to changing conditions, and continue functioning without requiring perfect outcomes from any single variable. Because in systems influenced by time, uncertainty, and human behavior, stability is not a fixed state. It is an ongoing process. And within that process, $1 million is not a guarantee. It is a resource. One that must be structured, managed, and continuously aligned with real-world conditions in order to remain effective over the long term.